Hey everyone, welcome back to Yuri's Box. In this video, I'm going to give a quick update, hopefully, to what happened today in the markets. If you like this kind of content, consider leaving a like and perhaps even subscribing. And as usual, nothing in this video is financial advice. So I think this is the best place to start. I follow Reliant Capital on X. I think, all the people that I have in my bio really are worthwhile, in my opinion, following on X when it comes, down to financial markets. And I think that, what is being highlighted here is a lot of what is behind the recent announcement on tariffs. All right. So the bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. But yeah, I saw last night where people were getting a little queasy. So in case you haven't heard, we had an update just a few hours ago, and we have been catapulted potentially, back here to what I was saying. I think yesterday's video and really what to expect for April 9th. And point number one is check. Okay. For the simple reason that, what basically was announced is, again, a freeze of the reciprocal tariffs on allies and partners. But we do have the baseline of a 10% tariff going online. During the 90 days, I would imagine that you get, negotiation. All right. I spoke about perhaps Europe, cutting deals in regards to energy, because again, as ridiculous as it is, for all the saber rattling against Russia, the EU is still de facto financing the war in Russia by, purchasing practically half of its energy requirements from Russia. Okay. And again, it's not buying it from the US. So I think that there is room for a deal specifically on energy. But again, it could take many different shapes and forms. At the same time, though, we got potentially even worse news on China, because we no longer have a 104% tariff, because we have a 125% tariff, which again is even potentially higher than that, because again of potentially imports from Venezuela being tariffed. So potentially even more. Let's update this than 125. 125, potentially more than 125. All right, maybe 130, something like that. I have no idea. I don't know the maths. But in any case, for the time being, I listen to a lot of people, different takes, and I think that I feel comfortable saying a few things about this announcement. First off, if it makes any sense, this announcement really doesn't do anything to make the world better. It just takes the possibility of the world being in a much worse place off the table. All right. So what I'm getting at is that, yeah, I mean, we have the worst case off the table for the time being, but it's not like we're having, extra stimulus as an example. We're not talking about tax cuts. We're not talking about stimmy checks or, QE. We just don't have, the incredibly bad outcome, that was, reciprocal tariffs of 20, 30, 40, 50, 60%. And at the same time, you still have to, that was a nice voice crack, you have to consider the fact that we do have a 10% tariff baseline as a baseline. So at the end of the day, yes, we do have kind of the worst case scenario get whacked off the table. And again, as I was hinting at before, a lot of it boils down to what we saw tonight, and I'll go over TLT in just a minute. But again, this is what we have right now. So as things stand, potentially the biggest loser in all of this is, again, China. Because even going into this, my expectations were basically, well, this for April 2nd, okay? I spoke about this in my previous videos. And, going into this, my expectation was that if we were to see higher tariffs, kind of a more maximalist approach, from medium to high pressure being put on partners, that to me would be an indication that we're not really trying to use tariffs as structural policy. All right, we're not trying to make them permanent. We're trying to use them for cutting deals. Now, I don't know how much we can really say that for certain given what has happened, because what if what happened last night didn't happen? Would we still be talking about these high tariffs? That is something I think about, all right? But in any case, this is the end result. We do have at least the outlook of potentially cutting deals with partners, which at the very least lays the groundwork for getting everyone on the same page, all right? The reason why I hinted at, yes, China is definitely objective number one, but before you get to China, you kind of have to bring everyone back in line. And I was talking mainly about the EU, and again, the EU has a lot of commercial trading with China, and it has a lot of trading going on with Russia. That doesn't bode well with the US and the EU being allies. I mean, that kind of they're two contrasting things. So at the very least, what this announcement does is leave the door open for just bringing everyone on the same page when it comes to China. And again, the reason why that what we saw a couple of hours ago is negative for China is because now that everyone is kind of on the same page, more or less, and at the same time, China gets 125% tariff, and the world is at the very least still kind of sticking together, all right, if that makes sense. So what can I say? What can we say really about this huge bounce? Point number one, again, is that we take the worst case scenario off the table. All right. So we don't have reciprocal tariffs come online, which is good news. Second thing, it just shows you how much people were hurting. It just shows you how much pain and how much of really the pain trade was to the downside. And I think that is potentially something that you have to consider. That what we've learned so far is that hedging, preparing for downside risk, was not on the menu. All right. A lot of what we saw right here was people just getting caught swimming naked. All right. Now, this could very easily be, the bottom. And if you go back and look at 2018, for example, we did have a few instances where something similar occurred. Like, I'm pretty sure if my memory doesn't betray me, tariffs really started at the beginning of 2018. And we saw about a 12% rally downturn, which was really a buying opportunity. Later on in the during Trump's first term, we did see something similar with about a 20% drop in the markets. Coincidentally, this drop right here was because of some stress in the bond market, and potentially this could be the same exact thing. It could very well be. I think that there is still the big elephant in the room, which is China. As things stand right now, you have Russia that is bogged down in Ukraine, and China that has 125% tariff. That's kind of the headline for you. Again, what will happen with this 125% tariff? I have absolutely no idea. If I have to think in optimistic terms, I would imagine that there would be a deal with China as well. I have absolutely no idea what some kind of a deal would look like. But if I have to be an optimist, I would think that at the end of the day, it won't really lead to anything nefarious. But again, I mean, the lead up to April 2nd shows you that, as I've been saying, just because something sounds ridiculous, it's not wise at this point to kind of discount things. All right, I'd still be cautious because, again, what this move has pointed out is that we're potentially at kind of the opposite of what we were at the end of 2022. And I speak a lot about 2022 because that was kind of my defining moment, all right, of where I really learned a lot of things between 2022 and 2023. At the end of 2022, the pain trade was up because at this point, everybody was braced for a recession, right? This is when you saw Bloomberg articles with 100% chance of recession because this and that indicator is telling me that we're going to have a recession. And everybody was prepared for it. Everybody was, thinking about a recession. And if you go and look back, for example, at things like, risk-off asset, what you'll see is precisely that. Like, I remember a lot of people pointing to bonds and the bond market, with this kind of pullback in yields and really yields not doing anything for the first half of 2023 as to reason why we're going to have a recession, because the bond market is potentially pricing in, the Fed having to cut because they overdid it, which of course didn't happen, and because of that, everybody had to play catch up, and nobody was prepared for stocks going up. Potentially, now again, this is just me speculating. What this move has showed everyone, I think, is that nobody was really thinking about downside protection. All right. Now, does that mean that this is just going to fall through? I don't know. Nobody knows, really. But if I had to give you something to think about, I would think about the fact that things are exactly the opposite of what they were in 2022 in regards to kind of, the way people are positioned. Nobody wants to get close to, the long end of the curve because we still, to this day, have inflation, what I call inflation PTSD. And everybody wants to be long stocks. And I think that this move today, this 12% move on the Nasdaq, the 9.5% on the S&P, just shows you how much pain, in my opinion, there is in relation to stocks going down. All right. So again, and also the final and third thing I will say about stocks is that, for example, Goldman Sachs just scrapped their recession outlook for the year, which is understandable on one hand because you no longer have the worst case scenario on the table. All right, before it was a reality, really a potential reality. Now it's off the table, at least for the time being. All right. So that definitely, again, it just takes away the worst case scenario. But at the end of the day, I would just defer and to something that I said, in relation to China tariffs on Tuesday. Nothing really changed on Tuesday, all right? And we saw kind of the market discount the fact that, Trump potentially was pointing towards another 50% increase on tariffs if China didn't step back. And, he went through with it. So I wouldn't get too ahead of myself. Also considering the fact that we had a slowdown already going into this. All right. We looked at many things. I pointed out many things even before tariffs. Look at the quits rate. Look at the fact that we are off the highs. Look at the fact that continuing claims continue to be at cycle highs. Okay. Bankruptcies on the rise. And the reason why tariffs were kind of, extremely bad news is because we already had kind of the groundwork laid out for us. All we were needing just kind of a small spark to light everything up. Now, again, I think that the place to look will eventually be credit spreads. If something continues to happen that continues to fuel credit spreads up, that would be a reason for more concern. So again, you did see recession calls get called off, but again, I wouldn't get too ahead of myself when it comes to just signaling the all clear, because we still have things to deal with, and we're still not talking about things that will actually stimulate the economy. And again, things like Goldman Sachs, having pulled back their recession outlook is understandable, but at the same time, it is kind of looking through and taking for granted that a lot of things will end up okay, which is understandable. But what I say to that, again, is what I just finished saying, is that you really have to defer to what does the economy really look like? Well, I think we've kind of forgotten about the economy, all right? We really would look, everyone, and rightly so, was looking at tariffs. And I think we kind of lost sight of what the real economy looks like, potentially. So, all clear, maybe yes, maybe not. I still maintain a cautious outlook, and I wouldn't take on too many, big bets at this point. All right, that's all I can say about the S&P 500. To summarize, 125% tariff on China. Let's see how that plays out. China actually retaliated. This is what led to the increase. Increase from 34% to 84%. So let's see how that plays out. Europe and other partners really got a break or a delay of 90 days, but we still have the tariff, 10% tariff baseline come online, which again is not growth positive. All right, it's still a tariff and it's still going to act as a headwind on growth. So keep that in mind. Put that together with the fact that we already had a slowing economy. We already had signs that things were potentially not looking too hot. And then you have, at the end of the day, people just entities like Goldman Sachs pulling their recession outlook immediately, just pulling it off the table, which again is understandable because you do get the worst case scenario off of the table. But the question I want to leave you in regards to, things like stocks is, does it really make the world better? I mean, yes, of course, if you don't have the worst case scenario to think about, by definition, it does help out. But again, does it make the world better? Are we adding anything extra that we didn't have before? I mean, it's like saying I'm gonna chop my leg off and then I don't, and so I have a leg. Hooray! Yeah, okay. You're not, doing anything extra. If you get what I mean. So I would just think about that for the time being. And again, I'll follow through this, and speak about this more in more depth in another video. That is what I'll say for the S&P 500. On the rate side, so this morning I woke up and it was absolute carnage. All right, we had quite a day in the long end of the curve. So really, the 30-year yield spiked to 5%. All right, and really, this came on the back of what I pointed to immediately, because I looking at this kind of a wick. This immediately reminded me of my early days in crypto, really, when I just started out in crypto. And I remember seeing these huge wicks, just huge candles with, incredible movements, which was just, people getting liquidated. And that's the first thing I pointed towards. And in fact, that is really what it kind of looks like. Where does that leave the 30-year yield? So as things kind of cooled off on the tariff saber rattling today, we completely retraced today's move. All right, so for the time being, this is just a wick. All right, we wicked up to 5%, which, again, ironically, if you plot it out, that basically puts us at $85. So potentially we retested this white trend line that we broke out of back in February 21st. Simpler times, eh? So that's one thing to consider. Where do I see things going on the long end of the curve? On the 30-year yield, I would not be surprised. All right, I'll give you this tidbit right here. I would not be surprised if by the end of the week, this candle here just looks like a hideous wick, right? Like something like just complete retrace back to 435, and this just ends up looking like a doji candlestick. That would not surprise me at all, especially if tomorrow's inflation report cooperates, meaning that we get 2.6 or below on the headline inflation and on the core. You could also look at jobless claims, which given some of the credit spreads widening that we've seen, you could potentially point towards some uptick in it, but I'm not banking too much on that. I would think that tomorrow, if there is something that can definitely move things, it would be inflation data. So if inflation data cooperates till the end of the week, and things like things like China still aren't resolved, and we get hints of further retaliation and just things not cooling off, perhaps we could get back to the risk off environment. But again, we're still well above, and for the time being, this kind of pushes aside the 06 and 08 comparison, because again, for the time being, we're well above the bull market support 1 for 1. If I had to point at something, I would point, as I did this morning, towards this sell-off in the 30-year, akin to something like we saw with Bear Stearns, where we were in a risk-off environment, but because of stress and pain in the financial system, you had forced selling of the risk-off asset. But again, if the only thing that would make me reconsider potentially, just not actually shrugging this comparison aside, is if in fact we do get this candle just looking like an awful wick, just a huge wick, all right, from top to bottom. But again, that is just getting way too ahead of schedule. There are a lot of things that can happen, as you know, this week. I mean, it's Wednesday, but it feels like 3 months. All right, have elapsed. So again, depending on how things evolve, I think that the most likely outcome is that we go back to thinking about the real economy. I think that is what lies ahead. Actually, just going back to the fundamentals, and the fact that the fundamentals aren't really, were already potentially deteriorating, and potentially they were being masked by temporary factors like everything I've been talking about from September to January. We had port strikes, natural disasters, tariff front running, right, and the holiday season combined, that potentially made the economy look a bit stronger than it actually was, and potentially inflation worse than it really is. So I would, if I had to pay attention to I'll give you three things. First off, China. You want to see progress on China, whatever kind of progress we get. All right, so are things moving in a positive manner, or are things continuing to escalate? Second is credit spreads. All right, continue to keep an eye on credit spreads. Third, inflation tomorrow morning. I think that if inflation cooperates, you could see, I think, that be welcome news on all fronts, really, not just on the bond market. Given the kind of the whipsawing that we've seen, and given the fact that the worst case scenario is off the table for the time being, so it kind of makes what we saw today kind of makes the case for tomorrow's data not being a non-factor, like we saw instead of the non-farm payrolls at the beginning of the month. All right, the fact that we don't have the worst case scenario, in my opinion, just tells us that perhaps tomorrow's data will actually matter, whichever way it comes out. It could easily come in hotter because of the increased spending that we saw, going into the tariff month. I have absolutely no idea how it'll come out. Again, the third thing, in order of priorities is the inflation data. So let's keep an eye on things, and I'll do my best to keep you updated. So yeah, just to summarize, on the stock side, it is welcome news, but it is welcome news because everybody was just so exposed to stocks, in my opinion, and nobody was considering the downside. Nobody was even considering the fact that stocks could go down. And the reaction we've had so far, today, is really just kind of the release valve. All right, it is a sigh of relief. All right, if I had to put it in words, a sigh of relief. But potentially, what this tells me is that we could be staring at an environment which is actually the opposite of 2022, because in 2022 the pain trade was up. In end of 2022, 2023, the pain trade was up. Everybody was prepared for a recession, which never came, and so everybody had to play catch up. So the pain trade was up for a lot of people. Stocks have gone up, and nobody's prepared for the downside. And the happiness that I see today just tells me that, doesn't tell me, it makes me beg the question, have we kind of shifted, and is now the pain trade down? That is one thing I would consider. But again, I wouldn't feed into too much doom posting. That's just something to consider. And you also have recession calls getting called off quite quickly. But again, today, to that, what I have to say to that is, it's the tariffs getting kind of delayed doesn't make the world better. We're just back to April 2nd. We're just taking the worst case scenario off of the table, right? We're not looking at things really changing in a fundamental manner, because again, because in the example I made is, imagine you say, I'm going to cut my leg off, and then I'm not going to cut my leg off, and then, oh great, yes, of course, great news, but nothing fundamentally changed. So that's just a few things to consider. I'll leave it at that. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.